This is the Retirement Lifestyle Advocates radio program. I am your host, Dennis Tubergen. Glad you decided to listen in today. Hey, joining me in segments 2 and 3 of today's program is returning guest Dr. A. Gary Shilling. Gary is the editor and publisher of the very popular Insight newsletter. I'm going to get Gary's take on what's going on in the banking sector. I'll also get his forecast for stocks, bonds, and U.S. Treasuries, as well as the U.S. dollar. So you'll want to stay tuned for that conversation. I caught up with Gary this past week. And it is the month of March. It is your last opportunity to get a copy of the March 2023 special report titled Social Security Tax Reduction Strategies. The report talks about maximizing Social Security by potentially minimizing the taxes that you will pay on your Social Security benefits. And there are many ways to do that. They are discussed in the report. To get your copy of the report, all you need to do is visit the website, requestyourreport.com. The website, again, is requestyourreport.com. And when you request your report, I'll also send you a copy of the revenue sourcing book, as well as a bonus book, the best-selling book, The Little Black Book on Social Security Maximization. So you'll get a box of resources absolutely free and without any further obligation. To get your copy of the report, Social Security Tax Reduction Strategies, as well as the books, visit requestyourreport.com. Let us know where to mail the information, and we will be very glad to do that. You know, the big headline over the past couple of weeks has been banking. Silicon Valley Bank, followed by Signature Bank, followed by First Republic Bank, along with Credit Suisse, are all banks that have made headlines because in one way, shape, or form, these banks needed financial help to survive or to become solvent again or make depositors whole, depending on the story that we happen to be chatting about. Well, as I read the banking headlines and as I read a number of articles and comments, I was reminded of what Henry Ford said about the banking system. Henry Ford, founder of the Ford Motor Company, had strong opinions about the banking system. He said this: "It is well enough that people of the nation do not understand our banking and money system, for if they did, I believe there would be a revolution before tomorrow morning." Pretty interesting observation from a pretty bright guy. So what did he mean when he said it's well enough that people do not understand our banking and money system, for if they did, I believe there would be a revolution before tomorrow morning? Well, we operate under a fractional reserve banking system, which means that if you go put money in your bank has to reserve a portion of that money. The minimum reserve right now is 10%, and the other 90% the bank can loan out. The bank can invest. So, for example, if I go put $100,000 in my bank to buy some type of a product, whether it's a CD or whatever it might be, my banker, by law, has to reserve 10% or $10,000, but the other $90,000 can be loaned out. So any bank, even a healthy bank, could actually be suspect in the event there was a bank run, in the event there were too many depositors requesting that they get their money. Now, there is some comments that I thought were interesting, and these comments were made by a former chair of the Federal Deposit Insurance Corporation. Her name is Sheila Bair. Many of you probably remember that name. Ms. Bair appeared recently on Cavuto Coast to Coast and had some interesting comments. She said, quote, "I think this is more of a Bear Stearns moment. I think a lot of people, including me, said when they bailed out Bear Stearns, they increased moral hazard. They created an expectation of further bailouts. And that is now, we know after the fact, exactly what is happening. The Fed is making all investors whole, even those with deposits that were uninsured. As many of you are probably aware, FDIC insures up to $250,000 in deposits per tax ID number, but anything over and above that is not insured by the Federal Deposit Insurance Corporation. Well, both Silicon Valley Bank and Signature Bank had the vast majority of their deposits exceeding the insurance amount, and yet all the depositors are going to be made whole. So it's feeding into what Baer talks about in her interview, that there's been an expectation of bailouts put in place. And again, that bailout expectation is being reinforced by the way the Silicon Valley Bank and the Signature Bank failures are being handled. Now, Baer said this: there's no doubt in my mind Lehman Brothers would have solved its own problems earlier on. It would have sold itself, raised more capital, all of the above. If they hadn't thought in the back of their minds, they wouldn't dare not bail us out. We're bigger than Bear Stearns. That's the problem. That's the expectation you create. Then you don't do a bailout and you really have the system seizing up, as we saw when Lehman Brothers went into bankruptcy. Now, Baer, talking about the Signature Valley Bank and Signature Bank failures, said this: fear is not setting in, not rationality. And I think the problem was that they did bailouts of these two mid-sized banks, very tiny parts of the overall system, in the name of systemic risk, and that created a lot of uncertainty. Now, here's what Baer said that is absolutely spot on. She said the immediate problem posed by the situation in the banking system is this: if people start to panic and take deposits out of a perfectly healthy bank, they're going to force that bank to close, because banks do not reserve 100% of deposits. Now, many of you have probably seen the movie featuring Jimmy Stewart titled "It's a Wonderful Life." Baer used that as an example. She said, quote, "It's the classic Jimmy Stewart problem. We deposit money into a bank, they lend it out, they invest it in securities. It's not all sitting in a vault. If you try to get all the money out at once, you're going to force the bank to unnecessarily fail." That's exactly the case. There is no bank, to my knowledge, that reserves 100% of deposits. In fact, when you look at the numbers for Silicon Valley Bank, they were able to have more than 20%, pushing 25% liquidity by my math. They had requests for $42 billion in withdrawals on deposits of about $177 billion, and they only came up about $1 billion short. So there's a bank that had a lot of liquidity, but really couldn't survive the bank run. And that is simply the way the banking system works. So now maybe you have a better understanding as to what Henry Ford meant when he said, quote, "It is well enough the people of the nation do not understand our banking and money system. For if they did, I believe there would be a revolution before tomorrow morning." Now, Baer does go on to talk about how she thought the problem should have been handled. She said, "The government is trying to imply that all uninsured are protected, which they don't have legal authority to do. Again, the insurance limits are at $250,000. Frankly, this is putting pressure on community banks," she said. "It is really troubling." She said she thought the better way to communicate would have been to handle these two bank failures with the regular FDIC process. Uninsured depositors would have gotten sizable dividends this week, she said. You have to remind people that there are deposit insurance limits, remind people that some banks can and do fail. She said you have to be vigilant, and you have to leave it at that. So if you are listening to this segment of today's RLA radio program, what should you do? Well, number one, you should manage your deposits. If you're keeping a lot of money in any particular bank, it would be very prudent of you to, in my view, think about making sure that you are under the insurance limits at that particular bank. The other thing you can do, as I'll talk about with Gary Shilling in the next segment, is look at short-term U.S. Treasuries or other vehicles that you can also keep liquid or almost liquid cash in, where there is a reserve of 100%. Now, there is some additional information that we will send you on this topic, as well as the topic of retirement planning, when you request the March 2023 special report. The March report is titled Social Security Tax Reduction Strategies. You can get a copy of the report by visiting requestyourreport.com. And when you request the report, I'll send you a copy of the revenue sourcing book, as well as the little black book on Social Security maximization. The website, again, requestyourreport.com. Just let us know where to mail that information, and we'll be very glad to do so. I'll be back after these words with my special guest, Dr. A. Gary Shilling. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. Joining me once again on today's program is returning guest, Dr. A. Gary Shilling. Gary is the editor-publisher of the very popular Insight newsletter. I would encourage you to learn more about that. And if you would like to learn more about the newsletter, you can visit agaryshilling.com. You can also call the number 888-346-7444. I'll give that number again in this segment. But Gary, as we noted before we started recording, certainly not dull times in which we live. Welcome back to the program.
Oh, yeah. Well, that's what keeps guys like me and you in business, Dennis. Obviously, if everything were going smoothly, who would need astute commentators like you and forecasters like me? But there's plenty going on right now, and obviously we're looking at a huge problem in the banking area. And the real question, of course, is first of all, how far it's going to spread. Secondly, what regulators are going to do to try to continue to arrest it. But more importantly, what are the ultimate effects on investor behavior, investing, consumer spending, and the economy?
So, Gary, let's dig into that, because we had Silicon Valley Bank, followed by Signature Bank, followed by First Republic, followed by Credit Suisse. Where is this going to end in your view? I mean, is this a problem that runs extremely deep in the banking sector?
Yes, I think it does. It had its origin after 2008, the financial crisis. The Fed engineered low interest rates, and that reflected low inflation for a number of years, really up till the pandemic hit in 2020. And during that time, the Fed was flooding the economy with money, other central banks the same. We also had the bailout money coming in relation to the pandemic, and all this money really floated around. It went into two areas in this country. Principally, one was single-family housing, particularly as people fled big city apartments during the pandemic and went to suburbia and rural areas. But also, of course, it went into huge speculations. And the money was so readily available. Venture capital was surging, and of course this led to tremendous growth in bank deposits. It dulled any sense of worry about bank deposits over the $250,000 FDIC limit on insurance, and it led to a very, very relaxed attitude where, in effect, depositors who had deposited more than that FDIC limit really didn't seem to care. So we had a situation which was very, very conducive to speculation, and of course there was plenty of that. Silicon Valley was sort of the center of this, with all the venture capital operations and so on. But the whole thing was just wonderful until about a year ago when the Federal Reserve started raising rates. And boy, that was a dramatic 180-degree shift.
So, Gary, I was, kind of following what happened. I'm probably not to the same extent you were, but it seems to me that this is a problem that at least indirectly, partially was created by the Fed with these artificially low interest rates and all this quantitative easing, and now the Fed is, by trying to make all these depositors whole to this point, as I understand it, they're kind of trying to solve a problem that maybe they had a hand in creating. Would you say that there's some validity to that statement?
Oh, I think there is. I think there is. And, of course, these guys are mere mortals, and they aren't inherently any better forecasters than you and I are, at least not in my view. And so you do have reactions to current situations which don't always reflect what is unfolding. And, of course, none of us can foresee the future with any great perfection, but I think it's fair to say that the Fed was in retrospect at least overly accommodative, and even more important, the Federal Reserve, you got the credit operations there, which we principally think about, but also the regulatory operations, and it's in the Fed, it's in the states, it's in the FDIC, and so on, and the regulators, and I'm just writing our insight for next month, but regulators were really asleep at the switch on this one. They had all the red flags for Silicon Valley Bank back in 2019. They raised concerns, but they never forced any actions. The rating agencies, they were asleep at the switch as well. They were right up to the end with these bad banks, Silicon Valley Bank, Signature Bank. They were rating them as investment grade, their securities, and so you really had a pretty much universal euphoria here, and very little analytical concern. And of course, ultimately, you say, who's going to be looking over this? I guess a lot of it really depends on individual investors and institutions, and they can't really rely on regulators or monetary authorities or anybody else in a government or quasi-government position to do the job for them. Now, of course, that's pretty hard because everybody gets swept up. You wouldn't have bubbles if you didn't have a lot of true believers. If everybody were as skeptical as I am, and I think you are at times, you wouldn't have the bubbles to begin with. So it's tough to fight. It's tough to fight the crowd, but that's when it's important to do so.
Well, if you're just tuning in, I am chatting today with Dr. A. Gary Shilling. He is the publisher of the Insight newsletter, which is a very extensive publication every month. You can learn more about Gary's work by visiting agaryshilling.com or calling his office at 888-346-7444. Gary, I found it, I'll just say interesting that the co-author of the Dodd-Frank Act, Barney Frank, actually held on the board of directors of Signature Bank. And I don't know if there's anything to that, but I'd just like your comment if you have one.
Well, it's pretty common that Washington is a revolving door, that these people who have big positions in Washington, and they're not particularly well paid there, but then they go out into the private sector and really clean up. Barney Frank, since 2014, when he went on that board, has been paid $2.4 million. And he was a very strong advocate, not surprisingly, of easing the limitations on smaller banks. As a result of his pushing and others, they increased the limit of banks that required special supervision from $50 million in assets to $250 million in assets. Now that opened for Signature Bank and Silicon Valley Bank, and so that really put them in the pass zone. No real serious supervision, and so Barney Frank got his share of the loot.
Well, let me just for our listeners, as we've got about 4 minutes left in this segment, many of our listeners are concerned about their bank. They're concerned about, Is this going to spread? Am I going to be affected? What would you say to people that have those thoughts in their mind listening to this program today?
Well, I think they're legitimate concerns. Now, you've already had Signature Bank and Silicon Valley Bank deposits, regardless of size, basically guaranteed. Treasury Secretary Janet Yellen has basically said that they may have to step in with others. I don't think that that's a serious risk, but you do have uncertainty. You do have rigidities of the system, the problem of moving money around, particularly if things get tight. And I can tell you what we're doing in my own personal funds, our company, and we manage money, the excess cash there. We're putting it into Treasury bills and other safe short-term areas. I just say, why take unnecessary risk? I don't think you're getting paid for that, and leaving money in banks over $250,000 or whatever an institution needs for working balances, I just don't see any reason to do it. And I think for individuals, unless you really love the bank and the bankers love you, why take unnecessary risks?
Well, Gary, we do have a couple more minutes in this segment, so let me go back, and if we need to carry it over on the other side here, we can. But you had mentioned that a lot of these funds really went into the single-family housing market. Can you talk a little bit about what your forecast is moving ahead for housing?
Well, housing is very sensitive to interest rates, and that's because it's so highly leveraged. You think about it: if somebody gets a FHA guaranteed loan, puts down 3%, that's a 33 times leverage, and it means that any fluctuations in rates can make a huge difference, can wipe out their capital, and certainly can discourage people who don't have a lot of excess money from going out and buying houses, incurring new mortgages. You also have a lot of people who had low mortgages from earlier, 4% or less. Well, they were at 7%, they're back to 6%, a 30-year fixed mortgage, but they're locked in. So you have a situation in housing which may be stabilizing now, but at very low levels, and it's hard to see the circumstances, particularly given the Fed's pretty much guarantee that they're going to continue to raise interest rates. They are absolutely determined to kill inflation, to knock it down to their 2% target, and that process is far from completed. So I think housing is going to continue to be under a cloud.
Well, I'm chatting today with Dr. A. Gary Shilling. He is the publisher of the newsletter Insight. You can learn more about his work by visiting the website agaryshilling.com. You can also call his office to learn more about Insight. That number is 888-346-7444. I'll return after these words with my special guest, Dr. A. Gary Shilling. Welcome back to RLA Radio. I'm your host, Dennis Tubergen, and I'm chatting today once again with returning guest, Dr. A. Gary Shilling. If you're just tuning in, Dr. Shilling is the publisher of the Insight newsletter. You can learn more at agaryshilling.com. You can also call his office, 888-346-7444, and I'll give that number again in this segment. So, Gary, prior to the break, you had mentioned that you believe the Fed is going to be resolute in continuing to raise interest rates until inflation is tamed or brought under control. How much further do you think the Fed needs to go? How high do you see interest rates getting?
Oh gosh, they're in a 4.5, 4.75% range on the federal funds rate, which is their policy rate, and they're now more talking about 25 basis points, quarter of a percentage point increases rather than the 50 or 75 basis point jumps they had earlier. But I think you could see another 100 to 200 basis point increases, so in other words, 1 or 2 percentage points, because the Fed is absolutely determined they're going to kill inflation and kill it dead, and they made it clear they don't care what happens to the economy. Well, they do care, but they are willing to see a recession if that's what it takes to get inflation down. That's their primary concern, and it's damn the torpedoes, full speed ahead.
So Gary, it seems then that would it be correct to say that your view is that a recession is imminent, that we're going to see recession in 2023?
Yeah, we may already be in one, Dennis. Now, you never know that until way after it starts. No administration would ever want to be in the business of declaring the peak in business and onset of recessions. So it's left to a private organization called the National Bureau of Economic Research. This is the outfit that first studied business cycles extensively going back in the 1930s, and they're the ones that date it. Now, they do not call the top until they get all kinds of information and are convinced. They never change their call, so they want to make sure, and they're waiting for delayed data, revisions, and everything else, and it's usually well into recession, and sometimes even after the end of if it's a short recession, before they tell you where the top was. Well, that's kind of about as handy as a pocket in your underwear. So from an investment standpoint, so you got to look at other things. You look at things like stock market, you look at consumer sentiment, do orders for durable goods, in this case, the banking crisis, and so you look for things like that. And I'm convinced that if we're not in a recession, we're certainly close to its onset, and it'll probably run, the balance of this year and into next year. I think it's going to be drawn out for two reasons. One is the Fed wants to make sure that they've done the job. In the last four cycles, they actually shifted from credit restraint to ease before the peak in business. They saw they'd done the recessionary deed, they backed off. This time, I don't think they're going to back off prematurely because they are so concerned about killing inflation. The other delaying factor is layoffs. Layoffs occur when business sales and profits decline, and they already are in that mode. But a lot of businesses are going to be very reluctant to lay people off when they've spent so much time in the last year or so hiring them. To get that mindset shifted 180 degrees takes time and real conviction. So I think you're going to have a delay in layoffs. So between the Fed delay and layoff delay, I think the recession will be stretching out and probably extend into next year.
Gary, I was reading, I believe it was yesterday, that credit card debt in the United States has now topped $1 trillion for the first time. At the same time, it seems that retail numbers are down 3 out of the last 4 months. It seems like those two statistics are a bit at odds with each other. How would you reconcile those if you agree with that assessment?
Well, consumers, if you look at retail sales and subtract inflation and say what's happening to real retail sales, what's happened to physical goods that they're buying, they actually have been declining. You had a burst in January, backed off in February, but I think consumers have been generally cautious, and of course the fact that they are increasing their credit card debt, delinquencies rising, increasing auto loans, it suggests that people are pinched and they don't have as much money as they had earlier, and they had a lot of money earlier from the bailout money after the pandemic. But I think the consumers are really scared, and their sentiment is declining. And if you put on top of that this banking situation, and I think a lot of people are going to be a lot more cautious, a lot more concerned about the safety of their money, and they say, well, I've got a bank deposit I can fall back on, but if they have any concern that it may not be there, now that's regardless of whether it's going to be guaranteed by the Fed and FDIC and so on, but if they have concerns, it certainly can reflect their financial decisions and spending plans.
Well, I'm chatting today with Dr. A. Gary Shilling. He is the publisher of Insight Newsletter. You can learn more about his work at agaryshilling.com. You could also call his office at 888-346-7444 to learn more. So, Gary, with debt levels rising, I think, I don't remember the year, but you wrote a book about the age of deleveraging. And I apologize if I don't have the title exactly right, but
it's a long title.
It seems like this whole deleveraging process, this getting debt purged from the system, because of the Fed policy, it seems like this problem maybe has been exacerbated, and this whole process is going to be more painful than maybe it otherwise would have been. Is that a fair assessment?
I think that's true. I mean, these things come in cycles. I think we are in a longer term deleveraging process, but you've had recently a lot of spending really financed by the Federal Reserve largesse and the bailout money, but I don't think that changes the overall trend. And I think people are being more cautious. You also have other factors, demographics, aging population. People age, they tend to save more, spend less. They don't need to buy as many cars and baby equipment and so on and so forth. So I think you got a lot of factors that suggest longer term that consumers are going to be more cautious and they're going to be saving more of their money. And as I say, this banking crisis, I think, is a strong encouragement for people to save because they much less convinced that the future is going to be predictable and favorable.
Well, Gary, in the time we have left, if you expect the Fed's going to stay the course and continue to increase interest rates, for someone that has money in a 401k or an IRA and they're in traditional investment classes like stock funds and bond funds, let's start with bond funds. That certainly can't be good news for those investors.
Well, yes and no, Dennis, because bonds were certainly beaten up last year, but starting last October, bond prices, and I'm talking about treasuries. My concern is about treasuries because there you don't have the credit risk, and they have actually rallied on balance since then. Prices have gone up, and why is that? Well, yeah, okay, the Fed is tightening, but on the other side is the idea of a recession, which knocks down credit demand, makes treasuries more attractive, and also the safe haven aspect. And that's very important in terms of treasuries on a global basis. So I think, and I say our investment themes, and anybody who looks at our insight can see that. And by the way, let me say our investment themes. We did a compilation of our investment strategies, which we first published there in 10 months ago, in May of last year, and up through February, they had an increase of 8.6%. That portfolio equally weighted all of those themes, and in relation, of course, you've had substantial declines in stocks and other more speculative areas. But anyway, I think treasuries, but we're still very negative on stocks in general. I think they've further to go down. We had predicted a 40% decline peak to trough. We're down about 20%, so we've got another half of that to go. And I think weak earnings are going to be the primary driver, as well as further Fed restraint. I think the dollar is a safe haven. Things like housing still under a cloud. Growth stocks, they're dependent on earnings way out and the discounted present value, and the higher the interest rates, the less that current price and value is. So there are a number of things that say we spell out there every month, but I think you're still very much in a cautious investment strategy mode. At least that's our view.
So, Gary, just to finish up on the topic of stocks, it seems that when you do have a bottom in the market, that you have a lot of investors, throwing in the towel saying, I'm never going to buy stocks again. I can't believe I was ever that crazy. And we don't seem to be there yet. It seems that we still have this buy the dip mentality, which a lot of times, from just the people I've interviewed and the research I've done, means that there's more downside. Is there some validity to that in your view?
Yeah, the way I put that graphically is we haven't reached the puke point. The puke point is when people want to regurgitate their last equity and swear they'll never buy another one, and that's what you need for a good bottom, which you are just articulated. In other words, you need to run out of sellers. You need to get the last seller who can be shaken out, and then you're faced with nothing but potential buyers, and that's what makes good bottoms. And I'm very much in that camp that we're not there yet. I think we will get there, but you've had all the way up in terms of interest rates in the last year. The Fed has been raising rates. They've been saying we're going to really kill inflation, and investors periodically say, "Oh no, the Fed is almost through. They're not going to raise rates further. Stocks rally." And then Chairman Powell and other Fed officials come in and really say, that's not our intention." And it's been a sawtooth pattern along a declining trend in stocks. But investors, I share that view. Investors are not yet convinced that the whole thing is over, and we do need evidence of a nice, well-defined puke point.
Well, on that note, Dr. Shilling, the clock tells me we are out of time, but my guest today has been Dr. A. Gary Shilling. He's the publisher of Insight. His website is agaryshilling.com. The phone number to learn more about Insight is 888-346-7444. Gary, always a pleasure to catch up with you. I get terrific feedback when you're on the program, and I do sincerely enjoy our conversations and your perspective. So thank you for joining us.
I do too, Dennis. Look forward to the next one. Thank you.
We will be back after these words. I'm Dennis Tubergen. You are listening to the Retirement Lifestyle Advocates radio program. And thanks again to my special guest today, Dr. A. Gary Shilling, for joining us on today's program. I always appreciate Dr. Shilling's perspective. If you are just tuning in, I have available for you a March 2023 special report. It is titled Social Security Tax Reduction Strategies. I'd be glad to send you a copy of the report absolutely free and with no further obligation. To get your copy of the report, just visit requestyourreport.com. The website again, requestyourreport.com. And when you go to that website, you'll just let us know where you would like that report sent. And when you do that, we'll also send you a copy of the best-selling revenue sourcing book that contains a retirement planning strategy for today's economy. You'll also get a copy of the Little Black Book on Social Security Maximization. To get all that information, just visit the website, requestyourreport.com. One of the topics that I have been talking about on the program is the massive amount of debt that exists, not only at the federal government level, nearly $32 trillion now, but also in the private sector. And as private sector debt builds, I believe that's an indication that many are getting a bit pinched, to use a term that Dr. Shilling used in the last segment. They're resorting to taking on debt to meet living expenses. Now, just last week, credit card debt in the United States passed $1 trillion. Now, there is an article that was published on ABC News that talks about this. I'm going to give you just a bit about this, or a bit on the article. The article said U.S. consumers' total credit card debt exceeded $1 trillion for the first time. That's according to a new study by the personal finance website, WalletHub. Consumers took on an additional $92.2 billion in debt last year. Almost $100 billion in debt. That's the highest single-year amount going all the way back to 2007. The average household in the United States now owes $8,600 on credit cards. Now, Jill Gonzalez is the senior analyst at WalletHub, and she is quoted in the article as saying this: "We haven't seen anything like this. Consumer confidence is at its highest point. Since the recession, people have been saving up for houses, cars, new furniture, and appliances, which often get charged on credit cards." Now, Ms. Gonzalez is certainly entitled to her opinion, and perhaps her opinion is well-founded and well-researched, but in my humble opinion, that argument is nonsensical. If people have been saving up for houses, cars, new furniture, and appliances, wouldn't these same consumers be using their accumulated savings to pay off the credit cards after they made the purchase? I mean, if I had saved up for a new piece of furniture and I went and charged it on a credit card, when the credit card bill came, I would take my accumulated savings and I would pay off the credit card. I wouldn't keep that balance on a credit card. But that is not what is happening. Credit card debt is the highest that it has ever been, and Americans are carrying an ever-increasing balance on their credit cards. Now, in my mind, there is only one reasonable conclusion that one can come to. Americans are using available credit on their credit cards to make ends meet. They're feeling the pinch of inflation. Now, to validate my opinion, I did some research and I looked at just retail sales numbers. So certainly, if people have been using their savings to buy cars, furniture, and appliances, that should be reflected in the retail sales numbers. It is not. Let me give you a bit from a Market Watch article from last week. Sales at retailers fell 0.4% in February and declined for the third time in 4 months, pointing to a slowdown in consumer spending as higher interest rates take a bite out of the U.S. economic growth. So if what Ms. Gonzalez said was actually true, if people since the pandemic had been saving feverishly to buy new furniture, new appliances, new cars, wouldn't retail sales reflect that? But they're not. We are now seeing retail spending slow. So what does that tell us about what consumers are using their credit cards for? They're using their credit cards to exist. They're using their credit cards to close the gap because in an inflationary environment, real wages have been declining. So I believe, as does my guest on today's program, that we are headed to recession. I believe that we may already be in recession. I have felt that for all of last year. So how do you cope? How do you plan for retirement? Well, to that end, I'd like to invite you to get our March resources. I've got a report titled Social Security Tax Reduction Strategies you can get. Visit the website, requestyourreport.com, and I'll send you the report. I'll send you a copy of the revenue sourcing book that contains a retirement planning strategy for today's economy, an allocation strategy for today's economy. And I'll also send you a bonus book titled A Little Black Book on Social Security Maximization. If you're listening to this today and you haven't figured out how you are going to get your income during retirement, if you haven't figured out how you want to collect your Social Security, these resources, I believe, will be very valuable to you. At the very least, it will offer you another opinion. So again, requestyourreport.com is where you go to request all that information. That's all the time I have for today. I'll be back again next week. Have a terrific week.